Hello CA Foundation students, I hope your revisions are going on with full focus. In this revision series for the Negotiable Instruments Act, I have already uploaded part A of the video wherein we have covered the topics like basics of negotiable instrument, characteristics, what is a promissory note, what is a bill of exchange, their characteristics, what is a check, characteristics of a check, and also the topic of foreign instrument and inland instrument. In today's video, we are going to cover the next topics which are remaining after the topic of foreign instrument and inland instrument. So it will mainly cover inchoate instrument, then ambiguous instrument, presentment of instrument, when is the presentment not necessary, and rules of compensation. So quickly, this is a revision like one day before exam video. So we will focus on the keywords and it will help you to cover all the topics within least possible time, and then you can focus on the questions. So it will definitely boost your confidence. Do check it out till the end. We are coming to the topic of inchoate instrument. So what is an inchoate instrument? As the word says, inchoate, it is incomplete in certain aspects, but this will not suffice for your writing in exam. So we are going to move to the main module. What does inchoate instrument mean? It means an instrument which is incomplete in certain respects. Certain respects meaning the acceptor or maker or endorser of the negotiable instrument, he has signed the instrument and delivered the instrument to another person, but he has left the instrument blank, that can be wholly blank or he can write the words blank on it, and that is why such an instrument is called an inchoate instrument. This instrument gives the power to its holder to make it complete by writing any amount either within the limits specified therein or within the limits specified by the stamp which is affixed on it. So the holder, now for this topic we need to understand that the liability of the maker of the instrument is not unlimited. It depends whether the person who holds the instrument, whether he is holder of the instrument or whether he is holder in due course. If he is holder of the instrument, then the holder of such instrument cannot recover the amount in excess of the amount intended to be paid by the signer. That means if the signer was intending to make the negotiable instrument say for rupees 2 lakh, then the holder of the instrument cannot recover more than 2 lakh even if he writes on it 2 lakh 20,000 if the space was left blank for amount. And if the person, the holder is termed as holder in due course, then he can recover any amount on such instrument provided it is covered by stamp affixed on the instrument, right? But now we need to understand who is a holder and who is a holder in due course. That is not given in the module, but we will quickly have a recap of it. Who is the holder? Holder is someone who is legally entitled to possess the instrument and he is legally entitled to receive the money. So if Mr. A gifts a check to Mr. B, then is Mr. B legally entitled to possess the instrument? Yes, Mr. A has actually given him the instrument. Mr. B has not stolen the instrument. So he is legally entitled to possess the instrument. Is he legally entitled to receive the money also? Yes. So if these two conditions are satisfied, the person is called holder of the instrument. That the same example I have given above, right? So if there is some person who is termed as holder, then he can recover amount which is not in excess of the amount intended to be paid when the signer has signed the instrument, right? But he is a holder in due course. Who is a holder in due course? He is a holder who has received the instrument for consideration before maturity and received the instrument in good faith. Now say Mr. A gifted the instrument to Mr. B. Mr. B becomes holder but not a holder in due course because he has not given any service, not provided any goods. So he has not received the check for consideration, right? So Mr. B, who has received it in the form of gift, is the holder. But if Mr. B now transfers or negotiates the instrument to Mr. C, then Mr. C, and why did he negotiate the instrument? Because Mr. C has provided some service to Mr. B. Then Mr. C now will be termed as holder in due course for this instrument, right? So for becoming a holder in due course, these conditions are to be satisfied. Now, if what is in good faith? What is meant by in good faith? Now say Mr. A had kept the signed check blank amount in a drawer, right? It becomes an inchoate instrument, but some Mr. X stole the instrument. Now Mr. X kept the instrument with him for some days and before the maturity he transferred it for some value received to Mr. Y. right? Now Mr. Y does not know that this person, the previous person, had stolen the instrument, right? That means Mr. Y has taken the instrument before maturity, it is transferred to him before maturity, it is transferred for consideration, he is legally entitled to possess the instrument and receive money, plus he has received in good faith. That means he is a holder in due course, right? So that is holder in due course. Now a case study can come wherein they will ask you what is the liability of the maker of the instrument to so and so person. In that case, you will have to first verify whether he is a holder or holder in due course, right? That is the reason we have discussed this in detail, though it is a revision video, no concept should be missed. So I think inchoate instrument is clear now, but we still need to look at the legal language. So what does section 20 say? It says where one person signs and delivers to another a paper which is stamped in accordance with the law relating to negotiable instrument. We have already studied in the first video that every negotiable instrument has to be stamped except for cheque, right? And it is either wholly blank or having written thereon an incomplete negotiable instrument, it is blank or he has written incomplete there. He thereby gives prima facie authority to the holder thereof that you can complete the instrument. The authority is given to the holder as the case may be, upon it a negotiable instrument for any amount specified therein and not exceeding the amount covered by the stamp. The person so signing shall be liable upon such instrument in the capacity in which he signed to any holder in due course for such amount. So for holder in due course, whatever amount the holder in due course will write, the maker of the instrument, the signer of the instrument will be liable for that amount, but it has to be within the amount affixed, the stamp value of the stamp which is affixed on it, provided no person other than a holder in due course. If there is some person who is a normal holder, then no person other than a holder in due course shall recover from the person delivering the instrument, that is the signer, anything in excess of the amount intended by him to be paid thereunder. That means the simple version is written here, holder can recover only the amount which is intended to be paid by the signer. Holder in due course can recover any amount on the instrument which he writes, provided it is covered by the stamp which is affixed on the instrument, right? And now in this case, when we took the example of a thief who stole the instrument, thief is neither a holder nor a holder in due course, right? So for a thief, the maker or signer of the instrument, he will not be liable for any amount. That is also clear. I think you should focus on the keywords and the inchoate instrument topic is done. Coming to ambiguous instrument, what does your revision PDF say? Ambiguous instrument which either can be treated as a promissory note or a bill of exchange, and once the holder exercises his option, means once the holder decides that there is some ambiguity in the instrument because of which the holder is not sure whether to treat it as a bill of exchange or whether it is a promissory note. Right? Now, if he decides to treat it as a promissory note, the law says that the holder can decide whatever you have to choose from promissory note or bill of exchange. But once you choose it, then you are bound by whatever you have chosen. How are we going to write? Where an instrument may be construed either as a promissory note or a bill of exchange, then the holder may, at his election, treat it as either. So holder has the option to treat it whether as promissory note or bill of exchange, and the instrument shall be thenceforward treated accordingly. Then the holder cannot deny that he treated it otherwise. Thus an instrument which is vague and cannot be clearly identified either as a bill of exchange or a promissory note, it is an ambiguous instrument. We are not going into the detailed examples here. Why? Because it is a revision oriented video. You should it should help you one day before exam to write everything, right? In other words, such an instrument may be construed either as promissory note or as a bill of exchange. Section 17 provides that the holder may, at his discretion, treat it as either, like he can treat it as bill of exchange or promissory note, and the instrument shall thereafter be treated accordingly. Thus, after exercising his option, the holder cannot change that it is other kind of instrument. That is about ambiguous instrument, right? Direct theory question can be asked, a case study may also come. Now coming to the next topic, modes of negotiation. First, a very short topic. How we have already covered when we saw the characteristics of bill of exchange, right? Modes of negotiation. What does negotiation mean? It means the transferring rights under the instrument. It means as you know that negotiable instrument can be transferred any number of times, right? So negotiation means transfer of instrument, transfer of ownership of the instrument, right? And in case where the promissory note, bill of exchange or check, it is a bearer instrument. You know already what is a bearer instrument. We have covered it in part 1 of the video. If it is a bearer instrument, the negotiation will happen by mere delivery. Endorsement is not necessary. It will happen by mere delivery, and the delivery can be actual or constructive. Now, in the topic of importance of delivery, it is important to know what you have to write because questions are asked, and once we cover the topic, you should look at those questions, right, which are on the topic of importance of delivery. So delivery in case of bearer instrument, it can be actual or constructive. What is actual delivery? Actual transferring to the person, handing over physically to the person. And constructive delivery, it is delivery to some authorized agent, right, of the person to whom the delivery was intended. And in case the promissory note, bill of exchange or check is order instrument, it has to be negotiated by endorsement plus delivery. What does endorsement mean? It means writing the name of the person to whom you are transferring it and then delivering it, right? That is modes of negotiation. Very simple. You should not miss on such topics if they are asked in exam. Now coming to importance of delivery. Importance of delivery. Section 46. Delivery is of an instrument is essential whether the instrument is payable to bearer or order. Delivery is a thing which is common in both, right? But in case of order only, what is additional? Endorsement. The delivery must be voluntary, and the object of delivery should be pass the property in the instrument to the person to whom it is delivered. The delivery can be actual or constructive. Actual delivery takes place when the instrument changes hand physically, and constructive delivery takes place when the instrument is delivered to the agent, clerk or servant of the endorsee on his behalf, or when the endorser after endorsement holds the instrument as an agent of the endorsee. In short, if you are giving to someone on behalf of the person to whom you have to deliver, the authorized agent or servant, then it is called constructive delivery. I urge you to practice the questions which are there on this topic. At least look at them once. If you are watching this one day before exam, it will definitely help you if a question comes on importance of delivery. Because what happens is students don't understand what they have to actually write when a question comes on this topic. They don't even realize that the question is on this topic, right? Delivery is essential not only at the time of negotiation. So delivery you have to do 2 times, right? When you are negotiating the instrument, when you are transferring the ownership of the instrument, and also at the time of making or drawing of the negotiable instrument. The rights in the instrument are not transferred to the endorsee unless after the endorsement the same has been delivered. So if I make a check and keep it in my drawer, I have made it in your name, but still if you find it without me delivering to you, you will not become the owner of the instrument. That is the crux of this line. If a person makes the endorsement of the instrument, but before the same could be delivered to the endorsee, I make an endorsement in your name on the check, and before I could deliver it to you, the endorser dies. I should not have taken my example. The endorser dies. The legal representatives of the deceased person cannot negotiate the same by mere delivery thereof. Endorsement has already happened, but are the legal representative authorized agent of the person who died? No. So if it is an order instrument, now only delivery is left, but still the legal representatives cannot transfer the ownership, cannot negotiate the instrument by mere delivery. A question can be asked, a case study question can be asked on this topic. You can also read these lines if you are not clear on this. Now coming to the next topic of Section 138, very important, dishonour of cheque for insufficiency of funds in the account. We have already covered it in a short revision video, short YouTube shorts, but I will cover it here again. When is Section 138 applicable? Firstly, when a cheque was issued to discharge a legally enforceable debt or liability. So from this line, what is clear? The cheque was issued for legally enforceable debt or liability. If you are giving the cheque as a gift or donation or security deposit or a moral obligation or an illegal consideration, Section 138 is not applicable. So Section 138 says if a cheque was issued to discharge a legally enforceable debt or liability and the cheque is returned by the bank, that is, the cheque is dishonored. Why? Because of insufficiency of funds in your account or agreement made with the bank. What does agreement made with the bank mean? Say you had given instruction to the bank, do not pass the checks above rupees 2 lakh, and you yourself issued a check of rupees 2 lakh 50,000. Now the bank denied the payment, right? In this case also section 138 is applicable. So the reason of returning the check unpaid, that is dishonor of check, can be insufficiency of funds or because of an agreement made with the bank and the check was presented within 3 months from the date it is drawn. So condition before attracting section 138 penalty is the check was presented by the payee within 3 months from the date it is drawn, because the validity period of the check is 3 months, right? And after the dishonor notice was received, now the bank will give you the notice that the check is dishonored, right? You should inform the drawer of the check, right? So you have informed, you have given a written notice to the drawer. So within 30 days of dishonor, law says within 30 days of dishonor of the check, when you receive the intimation from the bank, within 30 days the payee has to inform the drawer. After those 30 days, 15 days time is given when the drawer of the check receives the notice from the payee. 15 days time is given to the drawer to make the payment. If he does not make the payment even in this 15 days, default by drawer to pay within 15 days of demand notice received by him. If all these conditions are satisfied, then section 138 penalty is applicable. Now before again going into section 138 penalty, I will quickly walk you through what is written in the module. When a check drawn by a person on account maintained by him with a banker for payment of any amount of money to another person from that account for discharge of any debt or liability is returned by the bank unpaid, either because the amount of money in that account is insufficient to honor the check, or it exceeds the amount arranged to be paid from that account by an agreement made with the bank, such person shall be deemed to have committed an offence and shall be punishable. What is the punishment? With an imprisonment for a term which may extend to 2 years, or with a fine which may extend to twice the amount of check, or with both, right? But when is section 138 applicable? The conditions that we discussed should be satisfied. Unless the below conditions are complied with, section 138 shall not apply. Which conditions? The check has been presented to the bank within a period of 3 months from the date on which it is drawn, or within the period of its validity, whichever is earlier. Demand for payment through notice. The payee or the holder in due course makes a demand for payment of the said amount by giving a notice in writing to the drawer of the check, and that notice is given within 30 days of receipt of information by him from the bank regarding return of check as unpaid. And failure of drawer to make the payment, the drawer of the check fails to make the payment of the said amount to the holder in due course of the check or the payee within 15 days of receipt of the notice. So after 30 days, within 30 days the payee has to give the notice. After that, after receiving the notice from the payee, drawer gets 15 days time. So the complaint under section 138 can be filed only after 45 days. So that is section 138. Now there are two more things which you should remember parallelly to section 138. We talked about the check being issued for payment of liability. Now section 139 says that the law presumes that the check was drawn for payment of a liability. When a check is dishonored, it shall be presumed that unless contrary is proved, holder of the check received the check for the discharge of any debt or liability. But this is a rebuttable presumption, meaning the maker of the check will now have to prove if it was not raised for issuing, if it was not issued for payment of a debt or liability, right? And section 138 says that defense in your own for your own saving is not allowed. It shall not be defense in prosecution of an offence under section 138. When a case is filed, when prosecution is happening under section 138, you cannot defend yourself, that the drawer cannot defend yourself by saying that you had no reason to believe when the check was issued that the check may be dishonored on presentment for the reasons stated in that section. If you are saying that I did not know my balance will be low, I did not believe that the check will be dishonored when I issued the check, that is not any valid reason under this section to defend yourself, right? So that is section 138, very important topic. Now a few important things about presentment of instrument. What is presentment? Presentment has to be done 2 times. One is presentment for acceptance of instrument, but acceptance is needed only for bill of exchange. So presentment for acceptance, and another is presentment for payment. Now in case of presentment for acceptance, if the bill of exchange is payable after sight, if it is payable, that is on demand, then it has to be presented for acceptance by a person who is entitled to demand the acceptance within a reasonable time. Even if it is a demand instrument, you cannot demand it any time. It has to be presented for acceptance within a reasonable time after it is drawn, and in business hours on a business day. For demand for acceptance, presentment for acceptance has to be done within reasonable time, right? If there is default of such presentment, no party is liable thereon to the person making such default. If the drawee cannot after reasonable search be found, the bill is dishonored for non-acceptance. So these are the few things you should quickly read. We are going towards presentment for payment. Like, not much important, but in case a question comes, these are very simple points, so quickly read them. I would suggest you can read it from here, but if you have not read it from module before, do cover all these small points which are there on page number 7.20 till page number 7.22, right? These points are small points, but they are important. So to whom the presentment for payment will be made? In case of a promissory note, the presentment for payment will be made to the maker of the instrument. If it is a bill of exchange, the presentment for payment will be made to the acceptor of the instrument, and in case of check, the presentment for payment will be made to the drawee of the instrument. If there is default in presentment, then it is not the default of the party who is going to make the payment. No party is liable for such instrument. Exception to this thing: if the present promissory note is payable on demand and it is not payable at a specified place, then no presentment for payment is necessary, but it has to be presented within a reasonable time. What is the reasonable time? It is usually during business hours, right? Within reasonable time, and that too during business hours, you have to present the check. If instrument is payable after date or sight, it must be presented for payment at maturity. If the promissory note is payable by installments, if part of the amount is payable on some day, part of the amount is payable on another day, and part is payable on another day, it must be presented for payment on third day after the date fixed for payment of each installment. So as we know, 3 grace days have to be allowed in that case for each installment. If the instrument is payable at a specified place, then it must be presented for payment at that place. Where no exclusive place is specified, then it must be presented for payment at the place of business or at the usual residence place. No known place of business or residence, if you do not know, then presentment may be made to him in person wherever he can be found. And if he is not found after reasonable search, you can consider it as a dishonor of the check. If it is an instrument payable on demand, then it must be presented for payment within a reasonable time after you have received the instrument. Now note that delay in presentment for acceptance or payment, it has to be excused if the delay is caused by circumstances which are beyond the control of the holder. If I am stuck in a lockdown, or if there is a natural calamity and I could not present you the instrument for acceptance or payment on the due date on which it had to be presented, right, in the reasonable time or whatever the date we saw according to these things, these rules, then in that case they are saying that delay in such presentment can be ignored, it can be excused. Now coming to a direct theory question which can come: when is the presentment unnecessary? That is, when is the presentment of the instrument not required? So if the maker, drawee or the acceptor, maker in case of promissory note, drawee in case of check, or acceptor in case of bill of exchange, who is going to make the payment, these people are going to make the payment, if they prevent the presentment, if say the person said that come to my shop and I will make the payment on this and this date, but his shop is closed. So you can remember these points in such a sequence. So this is the first point. If he is doing something like this to prevent the presentment, if say for example it was payable at a business place and that is closed on a business day during usual business hours also, or if it was payable at a specified place and the liable party does not come to that specified place, if it was not payable at a specified place and liable party cannot be found after reasonable search at any place, then in these 4 cases presentment is not required again. Also there are few more points. If the liable party is engaged to pay notwithstanding non-presentment, if he is saying that I will pay it, you need not present it. If the liable party waives off his right to take advantage, Like, if what did we say earlier, that if you do not present the instrument, the holder of the instrument, then no party is liable on it. But this maker, acceptor or drawer is saying that I waive off my right to take advantage, right? I will still make you the payment. So in these two cases also, the presentment is not required. If the liable party makes part payment, if he has already made 50,000, the check was for 60,000, or if the bill of exchange was for 60,000, now for 10,000 again will you present it? No. If the part payment is made, then it is not required. If drawer could not suffer damage from want of such presentment, if there is no harm done to the drawer because of your non-presentment, then in these 8 cases the presentment is not required. You should learn these points. Now coming to rules of compensation, the last topic. When the check is dishonored, what does the law say regarding compensation to the holder of the instrument? Section 117 of the Negotiable Instrument Act says, in case of a dishonor of negotiable instrument, holder can claim amount due on the negotiable instrument, whatever is the amount due. Now when the dishonor is made, you will have to follow a certain process. You will have to make noting of the instrument, go to the notary, make a noting, then you will have to incur the legal expenses. So expenses incurred in presenting, noting and protesting, all these expenses can also be recovered. So what are they saying? In case of dishonor of negotiable instrument, holder can claim amount due on the negotiable instrument plus expenses incurred in presenting, noting and protesting the instrument. All this is a legal process, presenting, noting and protesting the instrument. Along with that, along with amount due on the instrument, along with the expenses incurred on noting, protesting and presenting the instrument, you are also liable, you are also given interest at the rate of 18% per annum. From which date? From due date of the payment to the date of actual realization of the payment, that is till the date you get the payment. So interest at the rate of 18% per annum from the date of due date of the payment till the payment is actually made. And also in case of a foreign currency is involved, then you will also get the amount at current rate of exchange. So these are the 4 things you should remember for rules of compensation in case of dishonor of negotiable instrument. See you in the next topic, next video. Till then, watch all the revision lectures which I have already uploaded. Do take the benefit of the revision lecture for Companies Act because it is a scoring chapter, and wishing you all the best.